Talk about a volatile quarter on Wall Street, trade tensions, shakeups in Washington, interest rate worries, inflation, pushing the Dow and the S&P 500 into negative territory for the first quarter. The Nasdaq shining brighter with a slight gain on the quarter. All three major indices struggling in the month of March, however, all ending the month firmly in the red. What do investors need to hear from Washington to ease uncertainty and build confidence in markets heading into the second quarter? Let's look ahead right now with Haverford Trust Chief Investment Officer Hank Smith joining me right now. Hank, it's good to see you. Thanks so much for being here.
It's good to be with you, Maria.
Let's look back and look ahead. First, what struck you about the first quarter? And let's talk about where you think things are going second quarter and rest of the year.
Well, look, for a long time in 2017, we kept telling clients, you need to expect volatility. What we were experiencing in 2017 with no volatility was very, very unusual. So we certainly got our share of volatility in the last 2 months of this first quarter. But let's examine why this occurred. There are 4 factors in 2017 that the market was keenly paying attention to, and they were all about fundamentals. GDP growth was accelerating both here and abroad. Corporate profits were improving both here and abroad. Inflation remained benign, and interest rates stayed low and steady. And that created this environment that was just perfect for equities.
Yeah.
What has changed is inflation has ticked up a bit. Interest rates have ticked up a bit, reflecting that tick up in inflation, and the market is adjusting to that. Importantly, though, on the front end, GDP growth is going to accelerate this year. Corporate profits are going to be in the mid-teen growth in 2018, and we are going into the 10th year of economic expansion and a bull market, and we're gaining an acceleration in both GDP growth and corporate profits.
Yeah, it's pretty incredible. We saw a GDP number earlier this week of 2.9% growth for the fourth quarter.
Right.
That was good. So going forward, we're expecting earnings to be up 16.5% for the first quarter. We're expecting earnings in the S&P 500 to be up 18% for 2018, and we are expecting growth to continue to pick up in the year. How do you invest in that environment?
Well, look, you certainly need some cyclical exposure. There's no question about that. And so that would be in industrials, basic material, financials, technology. You can use the pullback in these sectors that we've experienced in the past weeks as an opportunity. But I also don't think you want to ignore the defensive side of the equation, consumer staples, healthcare primarily. We would avoid the pure interest rate sensitive sectors, utilities, telecommunications, REITs as an example, because I think they're going to be under pressure with this rising rate environment. So a balance between offense and defense may be skewed a little bit more toward offense.
All right. So a couple of things to point out. We're going to get some specifics on the U.S.-China trade relationship in the next couple of weeks. We understand that we're going to hear from the Treasury restrictions in terms of China being able to invest in the United States, as well as tariffs. That's one thing. Then we've got the first quarter earnings going to begin in earnest April 13th when we get the major banks. J.P. Morgan kicks things off. I believe it's April 13th. And then, of course, in a week, we'll get the jobs number. We will have the latest numbers in terms of employment for the month of March. Where do you want to be positioned going into all of these events in the next couple of weeks?
Well, again, I would say that investors should use this pullback in the market from the January highs as an opportunity, if you're not in, to get in. And again, a balance between offense and defense. And of course, if you're already in, you need to stay invested, and you're going to have to accept some of this volatility.
Right.
But I think we're going to have a good. I think the numbers that are going to be coming in over the next couple of weeks are going to be good. I think corporate profits, the earnings reporting season will be the perfect tonic for this market.
Now, what's your take on tech? Because obviously we had a little bit of a tech wreck this past week. All of the speculation and upset over Facebook. and their data abuses, where outside parties were getting access to all of our information on Facebook. Do you want to avoid tech, or was that an overreaction?
Well, I don't think you want to avoid it, and I think you use, again, these pullbacks to step in, but recognize whenever the specter of Washington is shining on an industry or a company, you're not going to necessarily get near-term performance, and I think that's where we are right now.
All right, we will leave it there. Hank, it's good to see you. Thanks so much.